once you've had that get to know you conversation with a potential buyer and you're moving into the next iteration of the process, what does that look like, Savard?
I think the next iteration of the process really follows somewhat of a system, depending on whether or not it's a sophisticated buyer or not. Also, if the buyer is a strategic buyer or if the buyer is a venture capitalist or a PE fund that's just trying to buy you out and add it to their portfolio of companies, that stuff matters too.
And for those that might not be familiar with strategic buyer,
sure,
you mean another company that's looking to grow.
Yeah, a company that's potentially in the same space or in an adjacent industry that's looking to add this business to their line of services that they can offer to their customers and clients. Someone that thinks that adding this is a strategic acquisition that they can make to improve their bottom line and increase their revenue and profits. So,
and it could be market share. It could be someone from a different geography looking to grow in your area.
Yeah, it could be a direct competitor looking to eliminate you from the market. Yeah.
Could be. You never know.
Yeah.
And so once they have that initial conversation, the buyer will typically ask for some more information, some more detailed information.
Yeah.
And what does that typically look like?
Yeah. So typically they want to look at your financial statements. They want to look at, some operational information, how many employees you have, are those agreements in place? What are your material contracts? If depending on the industry, if IP is a relevant factor or if real estate is a relevant factor, that type of information, customer and client lists, banking information. The buyer will likely at some point retain legal counsel that can conduct some other public registry searches to see if there's any other skeletons in the closet that looks like, lawsuits or WCB claims or security registration against any of your assets or the business as a whole, etc. But the step before that would then be making sure that before you disclose any of that information and you go too far ahead, having a non-disclosure agreement in place to protect it and to make sure that all the information is subject to confidentiality obligations on both sides.
And then once you start to disclose some of that information, how does a business owner understand what's too much, what's too little? Because there's two stages of disclosure almost in a way, pre-offer and post-offer, moving into due diligence. So before there's a price, before there's an offer on the table, there's kind of that first tranche of information. How does a business owner assess for themselves what's enough?
Yeah, that could be tricky, delineating between the two. I think from the seller side, you want to keep it as high level as possible. Ultimately, the goal, if you're in that now funnel and process, is to try to get an offer, solicit an offer from the buyer. So you need to give them enough information to allow them to assess your company, but not too much information at that point, because you want that initial letter of intent, LOI, in place before you get into kind of full-blown confirmatory due diligence. So I think on that point, you want to give them a couple years of financial records, some operating history, maybe you work with
person understanding.
You can work with someone to put together some sort of corporate overview or a term sheet that kind of outlines some high level things about the business. So, this many employees, this many years of operation, general figures that they'll be able to pull from, the revenue and the stuff like that, they'll be able to pull from your financial records anyways. So all the other stuff, and then kind of give them enough so they get a flavor for the business, and then you wait. And, sometimes buyers will push. Naturally, they want to get as much information as possible. But I think that at that point, there's a point where the seller, and this is where working with, advisors such as Village Wealth or brokers or whatever, or legal counsel helps. So you need to know where to draw that line and say, okay, I need an offer before we go further.
Yeah, I need an offer before there's more disclosed and shared. Yeah. And if the buyer doesn't go all the way and buy your business, you don't want to have overshared at that point if they decide not to buy the business. So enough, but not too much.
Exactly. Yeah.
Kind of a hard line to see something.
Yeah, it's a tricky balancing act.
Yeah. Okay. And so valuation. So business owner gets the call. They may not have an understanding of how much their company is worth. where their value's sitting.
Yeah.
What happens in that exchange when there's conversation around price?
See, that's a tricky one too. I mean, obviously the buyer is going to be the one that takes the first shot at that and sets a price. Very rarely will the seller initiate that and set an initial price. So I think always mindful to know that whatever that initial price is, there's always going to be some wiggle room in there, and
back and forth.
And back and forth. It's the start of a conversation and a negotiation. It's not what they're fixing the value of your business at. And sometimes that can be hard for sellers because, work really hard. This is your bread and butter. You built this for a number of years. And it feels like someone's lowballing you or whatever the case may be. It's important to keep in mind that that's just a starting point. It can be helpful to engage a valuations expert to come in. Now, the common theme on that is that can get costly. And there's lots of low-cost providers that can provide you a valuation of your business. If you work with your accountant, they've been through buying and selling multiple businesses for their clients, or lawyers that can do the same thing. There's formulaic ways of kind of calculating this, a multiple of EBITDA or some sort of factor of your revenue or profit. But I think ultimately, and the truth is, the value of your business is always going to be what you're willing to sell it at and what a prospective buyer is willing to buy it at. Yeah.
Yeah. And so as a business owner, if I get a call on my business, the buyer can present me an offer. If I want to question it, I can do so, or I could go get an independent valuator to do an appraisal as well, just so I have some comparison.
It can help substantiate things for the negotiation. It'll also help sellers, and we find this happens often, crystallize for them what the business is actually worth. Human nature is you're going to have a tendency to overvalue what the business is worth. And so getting a third party to look at it and provide you with some objective criteria, and maybe they have some comparables of businesses that have sold recently and give you it's like buying and selling a house, right? You're always going to think it's worth more than, what it might be, but getting some market information and intelligence can be helpful.
Understanding those value drivers and what makes one company worth more versus another.
Yeah.
And so, okay, we're getting past the conversation about price. We agree on price and terms and what the transaction is going to look like.
Yeah.
Then what? What happens once you're under offer? It's exclusive at that point. And what does that next phase look like?
Yeah, so I think getting legal advice before you sign a letter of intent is very important to make sure that the terms are market.
That's when you want to bring in your lawyer before you sign an offer.
Before you sign a letter of intent. The amount of times we get a letter of intent signed and sent to us by a client is shocking. And
I hear that from accountants too.
Yeah.
They're like, I was the last one to know. They don't like
that's important.
Yeah.
And I think it's harder then to negotiate out of certain commitments that you've made that you didn't realize you were making. So, letter of intent gets signed. Typically after that, lawyers are involved on both sides, or before that, the lawyers are involved. And so now they're already engaged. The buyer will get their lawyer to send over a due diligence request list that'll set out other documents that they want to see. They want to see your contracts. They want to see, your agreements, your employment agreements.
It's basically like an audit.
At that point, it can start to feel invasive and intrusive. They need to take a look under the hood to really see, what the business is all about. And it's really an exercise in trying to confirm what they already think is the case based on the initial phase of due diligence, and to identify if there's any potential skeletons in the closet or risks that need to be appropriately managed through the definitive agreement. So think of it like that, and it's an iterative process.
And for those that might not know, the definitive agreement being
a share purchase agreement or an asset purchase agreement that then
final
real agreement.
The real work agreement.
Yeah.
Okay. Thanks